So despite the market pulling down nearly 20% earlier this year, it's had a really nice recovery and everything's moving along pretty smoothly, a little too smoothly. So the question is, are we going to have a breather here in the market soon, or can we expect to finish the year really strong? Let's find out. My name is Brian Cannon and welcome to Markets in 5. So I've got several charts I want to go through today. Before I jump into that, though, I want to just kind of mention during the last Markets in 5, I'd mentioned that would we get a slump in September? Historically speaking, over the last 20 years, the S&P 500, the worst performing month, historically speaking, is September, and August was second behind that. So, what did it do this year? Well, August was up almost 2%, and September was up about 3.5%. So, really, really solid run of two terrible months, historically speaking. So, it just goes to show you that you can't pick one single indicator to make a decision. Rather, you have to look at the collection of all the indicators. And so we ultimately decided not to raise any cash preemptively because we were entering a soft period of the year. And the reason for that primarily is the rest of our indicators. So RSI came down and touched 50 several times, but held it. Okay, so there's zero reason for us to raise cash if the RSI is above 50, and then it took back off. Okay, we also have this uptrending, trend line, right? We're having higher highs and higher lows. And finally, we had the, get out of the way here, we had the MACD was above zero, okay? So the rest of our indicators were saying, hey, green light, let's go. And while several historical indicators were saying, hey, it might be a little bit rough coming up. And so we decided to stay in, and that was the right call. And so what can we expect moving forward? Well, really, we want to make sure that RSI holds above 50 quite simply, and MACD is positive. And we want to see this uptrend continue. We want to see higher highs and higher lows. Now, when we end up breaking this dotted blue line, that would be kind of a reversal of an uptrend. And doesn't mean a major downtrend's coming, but we would want to start watching the indicators and start to watch the various levels of support, whether it be the 50-day or the 20-day or the 100-day moving average to come down and to look for support. But as it stands right now, the S&P, it's looking good, and so hopefully we can finish this year strong, put one in the history books as a win, and move on. Okay, so again, although we don't look at one single indicator to make any sort of decision, we want to look at the collection of all. We do look for various indicators to kind of help guide our decision making, and possibly get ahead of things a little bit earlier, without, again, reading the tea leaves. When the VIX, which is the fear indicator, the volatility index, is highly correlated to the S&P 500, generally speaking, that means that usually there's either a pause in the market or potentially a pull down, and sometimes a strong pull down. And so right now the VIX is very low, the low levels historically speaking. And so the correlation, however, is pretty high. So we've got a VIX that's rising along with an S&P 500 that's rising. So again, something is bound to happen, and that's either going to be a pause in the market where we have kind of a small pullback and sideways action, or it could lead to something larger. So historically speaking, when you look at the times here that the S&P and the VIX were highly correlated, usually it led to either a sideways market or, again, a strong pull down. And in certain cases where we had a change of structure where the S&P was higher highs and higher lows and then broke it, generally speaking, then we had stronger pull downs, 22%, 34%, 23%, down 11%, down almost 20%. And so those were the times where essentially we had a change of structure in the trend, along with a correlated index that essentially led to a stronger pull down in the market. This was the one exception where we did not have a strong correlation between the VIX, yet we had a pull down in the market. So the VIX did rise and the S&P did fall, but the correlation in advance of that fall was not there. So it doesn't work every time, but it is something that, historically speaking, it's something that you can look at as a guidepost to start making some decisions. All right, so the last chart here is showing you the prime rate relative to the stock market. And you can see that over the last 20 years, generally speaking, when the market starts to roll over, the Fed begins to lower rates. Why do they lower rates? Because they want to spur economic spending. They want to try to get people spending money to pull this market out of the doldrums. And so 2000 to 2003, you can see a precipitous drop in rates. Same thing from '07 essentially down to '09. They dropped it all the way down. So they are starting to drop rates now, but the market is not rolling over at this point. So we'll just keep an eye on it. I mean, it's good that rates are dropping, makes everything cheap, but they're also trying to not drop them so fast because they're trying to avoid inflation, which could potentially lead to stagflation. So if you've got a slowing growth and you've got high inflation can lead to stagflation, and so that's a very difficult thing to pull out of for the government. So I know they're trying not to drop the rates too far too fast, because it could reignite, strong inflation. But if this market were to roll over, you could anticipate that these rates would drop. And so again, just another indicator that we're watching. So in wrapping up, I think it's important to watch the various indicators and help them guide us. However, not use them to make independent decisions. We want to look at all the indicators collectively, including the trends. And as long as we do that, I think we can stay on the right side of the trend in the long term. So, but if you have any questions, give me a shout, and I'll see you on the next Markets in 5.